Tom Halverson, thank you for being with us again for another checkpoint on the economic situation here in the US. We want to use our time with you today to focus on two things. One is to take a look at the September meeting of the Federal Open Market Committee and the steps the Fed's continuing to make to address the very big problem of inflation in the economy. That's number one. Number two is we want to get your perspective on one of the really big inflation drivers that's out there right now, which is the cost of energy. Electricity in particular, electrical power costs are rising much faster than people are used to. That feels like a really big deal. We want your take on that issue.
Great. Look forward to it. It's a highly dynamic story, and I know that everybody's very interested in it.
So let's set the context by looking at the growth situation here in the US. We'll bring up a chart that shows just how quickly the picture, the growth outlook for the economy has evolved over the last several months. Each of these bars is the median projection from the Fed for GDP growth in 2022. Last December, they were projecting 4% growth in the economy. Now with the latest numbers, it's 0.2%. That's just a huge change. Talk about this. What does it mean? And what do you think when you look at this picture?
Well, what I think when I look at this picture is obviously it's not a great situation for the economy to go from a situation where we thought it was going to be growing on an above long-term trend basis to basically not growing at all, and to go through an adjustment in expectations and reality of that magnitude in such a short period of time. I wouldn't say it's unprecedented, but it's pretty unusual. And one of the principal drivers of this outcome is the fact that after 20, 25 years of trying to generate inflation in this economy unsuccessfully, we now have more than we can possibly stomach, and we're trying to deal with it. One of the consequences, of course, is that the higher level of inflation is grinding away at purchasing power, and nominal numbers, when translated as these bars are into real numbers, the real economy is not growing like we thought it would and expected it to.
The Fed has made it very clear that they are determined to deal with this inflation issue in their language and in their actions. And we'll bring up another chart here that shows the course of the federal funds rate that the Fed controls over the last couple of years. And then you can see on the dotted line what they now project that to do over the next couple of years going forward. Just walk people through what this chart shows and interpret it for people in terms of what it means for borrowing, the cost of money, et cetera.
There's a couple of things that I would want people to observe. Number one is this is a short period. If you went back, another 20 or 30 years, it would look a little bit different. But the point I would make would still be the same, which is number one, the slope of that upward curve of interest rate increases over the last 12 months is very, very steep. It's not like that, but it's very close to that. We haven't seen a rate increasing slope like that in a long, long time. And therefore, that's a rapid dislocation in monetary conditions of a type that none of us are used to. The second thing that I would say is that if you went back and looked at the cycles we've had over the last 30 or 40 years, they've tended to be pretty fast in terms of interest rates went up, they reached a terminal level, and then they came back down because the economy contracted or dramatically slowed. What this projection says is that interest rates are going to be, in my words, interest rates are going to be higher for longer, right? They're going to go up higher than anybody thought because inflation is higher. And the expectation that the Fed has, and as in these projections, demonstrates is that they are not going to just immediately go back down to where they were before, which is to the zero zip code, right? We're going to be living in a world of non-zero interest rates as far into the future as we can project right now. And therefore, the reality is very few, if any of us, are used to or experienced at running our businesses or operating in an environment of high inflation, certainly, but in an environment of 3 or 4% 10-year bond yields or federal fund costs and people are not used to that. It's going to be a very different operating environment for people. The average tenure of a S&P 500 publicly traded company CEO in America is 5 to 7 years. So there basically aren't any CEOs of any S&P 500 companies who've ever run their businesses in these kinds of conditions. That's certainly true for me, for most of our customers too. And so people need to be thinking about what the impact is of this environment on their business and how they're going to operate their business differently than they've ever done before.
Let's pivot now to the second topic that we teed up, which is energy costs. If you go back to February when the Russia-Ukraine war started, there was a lot of concern expressed at the outset there about food costs because the Ukraine's a major food exporter, et cetera, and that there would be maybe famines and things like that. But what's happened in actuality is a lot of the pain's actually being felt on the energy side across the world. Can you just talk about what's happened and what your perspective is in terms of the energy situation in the world today?
Happily. As a fastidious historian, however, I would tell you I wouldn't describe the Russia-Ukraine war as starting in February because it started in 2014. This is just the latest escalation when Russia decided that Crimea and parts of the Donbass were not enough and they wanted the whole country. It has precipitated and catalyzed, frankly, a degree of dislocation in the supply infrastructure for energy and of prices in energy of a type, of a magnitude that we haven't really seen in several decades. And it is making for tremendous pain and dislocation, both at an economic level, particularly in Europe, who are the people who are closest to and therefore most dependent on the Russian Federation for their supply of natural gas and oil. And that's a big, big problem. And thus, as much pain as we're suffering from energy price volatility and increasing here in the United States, it's much worse in other places, particularly in Europe. So it's hard to understate the sheer magnitude of the energy dislocation process that we're in, because it's going to last for years, not weeks and months. It's not a traditional, supply problem, which will be addressed by throwing more supply into the world energy system. The reality is the people who are dependent on Russia for their energy have decided they made a terrible strategic historical mistake to become so dependent on Russia and now have to find a way to get out of it because the Russians have weaponized the use of fossil fuels to achieve other strategic military and political objectives.
Just a follow-up question on that. You've talked in the past a lot about the energy transition that the world is going through over time from a fossil fuel-based energy system to one that's based on renewables and other forms of lower carbon energy sources. What do you think this situation is going to do to that transition? Is it going to slow it down, accelerate it, disrupt it? What's going to happen?
It's a great question, and people see what they're looking for or want to see sometimes. The reality is what I think is happening is in the short term, people have to have energy, right? European countries can't allow their people to either starve or freeze to death this winter, right? And therefore, the Germans, for example, they're going to burn coal that they didn't want to burn. And they may extend the life of their nuclear power plants that they otherwise wanted to shut down. But those things, in my judgment, are short-term measures to safeguard the health and well-being of their economy and their population. In the long run, their judgment collectively seems to me to be they've made a terrible judgment, an historical error to become so dependent on the Russian Federation, who are demonstrably unreliable and dangerous to depend upon. And therefore, they are going to accelerate their efforts to get out of that dependence, which means they will accelerate the energy transition they were already on, which will include renewables, but it will also include diversifying and relying on imports, for example, of liquid natural gas from the United States, which is a giant net exporter of energy these days and will continue to grow in that respect. So my own judgment in this regard is that it's likely to accelerate the speed of this decades-long transition, even though if you look at what's actually happening in the market today, that doesn't look like it because they're burning more coal and doing these other things. I just think that that's a temporary measure, but that the long term will be an accelerator.
Let's bring it into the US. We'll bring up another chart here that shows the latest CPI numbers from the government and the drivers of inflation. You can see here energy is by far the biggest, according to the latest numbers, 24% year-over-year increases in energy of all forms. Talk about this chart. What do you see here, and what does it mean?
Well, people are concerned about the 8.3%, right? That's the headline number. But what this chart tells you is that when you unpack the all items thing, what's in there, there's some big individual drivers, including food and energy. 23.8% is a big number. That means that a significant amount of the purchasing power erosion for consumers and frankly for businesses is happened because of that dramatic increase in the cost of energy over many months. Now, the reverse side of that coin, of course, is that now oil prices have come off meaningfully in the last 2 or 3 months, and therefore that 23.8 number is going to be a leader in coming down closer to 8.3. But we don't believe that energy is going to go below the all items, right? So it's going to be a meaningful contributor to the deceleration of the inflation rate, but there's still pressure here, right? And that pressure manifests in food, for example, where even though corn and soybeans and wheat may have come off a lot from their recent highs, once it leaves the farm field and gets out to be turned into food products or other things, there's a lot of energy costs that go into that, and thus food inflation is above the all items inflation, and that too may stabilize. But it's not likely to come back down to being, at the CPI level or below.
If you unpack the energy basket and look at the various components of it, those are shown here. I want to focus specifically on electricity. It's the lowest contributor here in terms of the increases, but it's up a lot, 16%. And this is a category of expenditure that really matters to people, really matters to businesses. Talk about this and what it means for the economy.
Well, people tend not to think about the correlations between the costs of different things that are in their consumer basket, right? People are much more used to this high volatility of fuel oil as it manifests ultimately in gasoline prices. They go up, they go down, and people like it or don't like it, but they're used to it. They're used to seeing that. One thing they're not used to seeing over long periods of time is anything like that kind of volatility in the cost of electricity. Right? If you really look at electricity relative to all of your inflation indicators, there's really not been any inflation in electric power for several decades. And so the industry is used to and consumers are used to electricity just sort of on a national average basis, tracking along, flat to inflation. Now, what you pay as a consumer depends on who your provider is, and everybody's individual story may be a little bit different, but in aggregate, there's really been no volatility and no cost inflation in the electric sector for a long time. And therefore, the fact that it's manifesting in the electric power sector is really quite interesting, and we haven't seen this in a long time.
We have a final chart that illustrates that here, which just shows the annual change in electricity costs over the last decade or so. We finance at CoBank this sector, the rural power sector. You talk a lot to executives and board members in that industry and these utilities that power rural communities. What do you hear from them in terms of what this means? Are they concerned? What's the expectation in terms of what utilities will do in response to this, what government or policymakers may do? Where are we going to be a year from now or 2 years from now if this persists?
Well, you're exactly right. We have the good fortune to be a significant financier to the electric cooperative industry, both the generators and the distributors of electricity. And I've had the good fortune to to speak personally with probably several hundred of those leaders over the last several months. Obviously, the situation is different for each individual institution, depending on a variety of things, what kind of power generation fleet it has, if they're a generator, whether they're in the Pacific Northwest because they have hydropower and a different fuel mix versus the Midwest or the East Coast or the West Coast, et cetera. So, averages are just averages, and everybody's situation is unique. On the other hand, the reality of the conditions in which people are operating these businesses is becoming and is quite challenging. The way I've described it to the leaders of that industry is, I think and expect that we'll probably have more change in that industry in all of its attributes over the next 5-ish plus years than we've had for in recent decades. There's just an enormous amount of change coming. And we knew that before this chart manifested. Now we have all that change we were seeing with the energy transition and public policy and everything else, plus an inflation problem and a cost problem, and therefore an additional challenge for leaders in that industry to manage. And this is not going to be an easy one to manage because their consumers, as you can see here, are not used to this, right? If you look at the years 2010 to 2020, you have basically zero, and so, going from 0 to 15%, 15.8% increase in electricity costs is a big, big change. People are not used to it. So if you happen to be, one of those co-ops or people in the electric industry whose costs have risen dramatically, and you have to pass that on to your consumers, they're going to be pretty unhappy with that.
We are going to continue to follow this. I'm sure we'll be back to you to ask your views as the situation progresses. Thank you so much for your time with us today.
Thank you. We're all going to be watching this with great interest because, as usual, we are living in unprecedented times.